Andy Schectman just said something on record, something he didn't have to say, across multiple platforms, deliberately, publicly. He called out one name in the precious metal space, not casually, not once, but repeatedly. He said this channel saw the refinery crisis coming, long before the industry even knew there was a problem, before the bottlenecks, before the margin hikes froze everything, before liquidity disappeared. Now ask yourself this. Why would a man with decades in this business, a man who deals with institutional buyers, a man who has nothing to gain from public endorsements, why would he stake his reputation on validating someone else's early warning? Unless that warning was about to become everyone's reality? Welcome to Financial Crisis Explained. Now, if you've been around long enough to remember when a handshake meant something, when a man's word carried weight, then you understand the value of what you're about to hear. Do me a favor, hit that subscribe button. Not because I'm asking, but because at your age, you know better than most. Good information is rarer than honest people. And before we go further, drop a comment below. Tell me, where are you watching this from? What city? What country? I want to know who's paying attention while everyone else is distracted. On April 10th, 2025, something unusual happened in the precious metals industry. Andy Schectman, founder of Miles Franklin Precious Metals, sat down for an interview. And he did something most industry veterans rarely do. He publicly endorsed another voice in the space, not with a passing mention, not with polite acknowledgement, but with specific, deliberate validation. He named OG John. He called the analysis legitimate. And he said something that should make every serious investor stop and reconsider how they gather intelligence. He said OG John was talking about refinery problems long before anyone else recognized there was a crisis. Now, understand who Andy Schectman is before you dismiss this as industry gossip. This is not a YouTube personality chasing clicks. This is not a social media influencer playing financial expert. Andy Schectman has been in the precious metals business for over 3 decades. Miles Franklin has facilitated billions in transactions. They deal with institutional buyers, pension funds, family offices, high net worth individuals who don't make decisions based on hype. When someone at that level speaks publicly, when they put their professional reputation behind a specific claim that carries weight, because they have nothing to gain from public endorsements, and everything to lose if they're wrong. So when Schectman appeared on multiple platforms over several days and repeatedly mentioned one specific analyst, one specific channel, that wasn't accident, that was intentional, that was calculated, that was a signal. He didn't just say OG John was pretty good. He didn't offer vague praise. He made specific claims. He said the refinery analysis was ahead of the curve. He said the information was authentic. He said, among all the content creators covering precious metals from an analytical standpoint, this channel stood out as legitimate. Think about what that means. In an industry flooded with noise, with conflicting opinions, with dealers pushing inventory, with affiliate marketers disguised as analysts, with fearmongers manufacturing urgency, a 30-year veteran publicly separates one voice from the crowd, not based on subscriber counts, not based on production quality, not based on personality, based on accuracy, based on timing, based on identifying problems before they became consensus. The specific issue Schectman highlighted was the refinery crisis. OG John was discussing bottlenecks, margin pressures, delivery constraints, liquidity freezes, while the rest of the industry was still operating under the assumption that supply chains were functioning normally, while mainstream analysts were focused on price charts and technical indicators, while dealers were assuring customers that product availability was merely a temporary inconvenience. OG John was explaining why the refinery system itself was breaking down. And here's what makes this validation particularly significant. Schectman didn't just acknowledge the analysis in hindsight, he specifically noted the timing. He emphasized that these warnings came early, before the problems became obvious, before the market-wide recognition, before it became safe and easy to talk about supply issues because everyone already knew. That distinction matters, because anyone can identify a crisis after it's headline news, anyone can explain a problem once it's consensus. The strategic value lies in recognizing structural weaknesses before they cascade into market-wide disruptions. That's the difference between reactive participation and proactive positioning. That's the difference between getting caught in a supply squeeze and securing allocation before constraints tighten. That's the difference between paying panic premiums and accumulating at rational prices. And that's exactly what Schectman was acknowledging. Not lucky guesses, not sensationalism that happened to align with events, but systematic analysis that identified vulnerabilities in the supply chain architecture before those vulnerabilities became critical failures. Now, this raises an important question. Why does early warning matter in precious metals markets? Because unlike equities, where you can execute trades in milliseconds, where liquidity is deep and continuous, Physical precious metals operate on different mechanics. Refining takes time. Minting takes time. Delivery takes time. And when bottlenecks emerge, when capacity constraints bite, when margin requirements freeze operations, the lag between recognizing a problem and securing physical allocation can be weeks, sometimes months. By the time mainstream awareness hits, by the time financial media covers supply issues, by the time your local dealer admits there's a problem, the strategic window has already closed. Premiums have spiked, availability has vanished, and you're not making investment decisions anymore. You're competing for scraps. This is why Schectman's validation matters. This is why his public acknowledgement across multiple appearances signals something significant. Because in a market where information quality determines positioning, where timing separates strategic accumulation from desperate scrambling, credible early warnings are the highest value intelligence you can access. And someone with 3 decades of institutional experience just told you where he found it. Let's go back to early 2024. While silver price discussions dominated every precious metals forum, while technical analysts drew trend lines and support levels, while YouTube channels argued about whether silver would hit $50 or collapse to $20, a different conversation was happening on one small channel. A conversation about something most investors had never even considered: refinery capacity. Not price predictions, not manipulation theories, not moonshot fantasies, but the unglamorous technical reality of how silver actually moves from mine to market, and why that system was showing signs of critical stress. Most people don't think about refineries. Why would they? You want to buy silver, you go to a dealer, you place an order, product arrives. Simple, except it's not simple. Between the mine and your vault, between raw ore and finished bullion, sits a complex, fragile network of specialized facilities. Refineries that process raw material into investment-grade metal, mints that strike coins and bars, logistics networks that move physical inventory. And in late 2023, early 2024, that network started showing cracks. Small cracks at first, delivery delays stretching from 2 weeks to 4, certain product lines temporarily unavailable, premiums creeping up despite relatively stable spot prices. Most dealers explained it away. High demand, temporary backlog, nothing to worry about. But OG John was looking deeper. He was analyzing refinery economics, margin requirements, processing costs, throughput capacity. And he identified something the mainstream conversation was completely missing. Refineries were getting squeezed, not by demand alone, but by a financial mechanism that most retail investors don't even know exists: margin hikes. When you refine silver, you don't own the metal outright during processing. You're essentially borrowing, holding positions, managing price risk during the conversion process, and those positions require margin, collateral, financial backing. In 2023, as precious metals volatility increased, as geopolitical tensions escalated, as banking stress rippled through financial markets, clearinghouses and exchanges started raising margin requirements, not by small percentages, but by substantial amounts. Some refineries saw their margin obligations double, even triple. Now think about what that means operationally. You're a refinery. You've got contracts to process silver. You've got delivery commitments. Suddenly, your working capital requirements just exploded. You need more cash, more credit lines, more liquidity just to maintain the same throughput. And here's the critical part. Many refineries couldn't meet those new requirements, not because they were poorly managed, not because they were unprofitable, but because the margin hikes came fast, came hard, and came without warning. So what happens when a refinery can't post the required margin? They freeze, they stop taking new contracts, they slow processing, they prioritize large institutional orders over smaller retail volume, and the entire supply chain downstream starts experiencing delays. Mints can't get refined silver, dealers can't get minted products, retail customers can't get timely delivery. But here's what makes this particularly insidious. The problem wasn't visible on the surface. Spot prices were still trading, paper silver contracts were still liquid, financial markets showed no obvious distress signals. So most analysts, most dealers, most industry voices kept operating under the assumption that everything was basically fine. Maybe a little backed up. Maybe some temporary friction, but fundamentally functional. OG John was saying something different. He was saying the refinery layer of the supply chain was experiencing structural stress, not a temporary backlog that would clear in a few weeks, but a financial constraint that was freezing capacity at the exact moment when physical demand was accelerating. He explained the margin mechanics. He connected refinery economics to delivery timelines. He warned that what looked like normal market friction was actually the early stage of a supply bottleneck. And critically, he did this before it became mainstream conversation, before Andy Schectman went public about refinery problems, before dealers started admitting that delays weren't just high demand, before the industry acknowledged that something structural had broken in the supply chain. Now, why does timing matter here? Because in precious metals markets, information advantage is measured in weeks and months, not seconds. If you understood refinery constraints were tightening in early 2024, you could adjust your purchasing strategy. You could lock in allocations before delays stretched from 4 weeks to 12. You could secure product at normal premiums before panic buying pushed spreads to irrational levels. But if you only recognized the problem after everyone else did, after mainstream acknowledgement, after dealer inventories dried up, after premiums spiked, then you weren't making strategic decisions anymore. You were reacting, competing, scrambling. And this is exactly what Andy Schectman was acknowledging when he publicly validated OG John's early analysis. He wasn't saying the predictions were lucky. He wasn't offering polite professional courtesy. He was recognizing something specific and valuable: the ability to identify structural problems before they cascade into market-wide disruptions. The discipline to focus on unglamorous technical realities while everyone else chases price predictions. The analytical framework that separates signal from noise in an industry drowning in conflicting information. Because here's the uncomfortable truth. Most precious metals commentary is garbage, recycled opinions, affiliate-driven product pushing, emotional narratives designed to manufacture urgency, very little actual analysis, very little supply chain understanding, very little recognition of the mechanical realities that determine whether you can actually get physical metal when you want it, and when someone with 30 years of institutional experience publicly separates one voice from that noise, when they specifically highlight early recognition of refinery problems. That's not entertainment, that's not hype, that's strategic intelligence validation, and smart investors pay attention. Here's a question most investors never ask themselves. Why do 10 different precious metals analysts give you 10 completely different conclusions from the same data? Same silver price, same supply reports, same market conditions, yet one tells you to buy aggressively. Another says, wait for a pullback. A third warns of imminent collapse. A fourth promises a moonshot. And a fifth says, none of it matters because manipulation controls everything. This isn't a difference of opinion. This is structural dysfunction in how information flows through the precious metals market. And it's costing investors more than they realize. Let's be brutally honest about something. The precious metals space has an information quality problem, not a lack of information. Too much information, contradictory information, incentivized information, information designed to serve purposes other than accuracy, and most retail investors have no framework for separating signal from noise. Consider the basic business model of most precious metals content creators. They're not analysts, they're affiliates. They make money when you click their dealer link and buy product. Now, is that inherently dishonest? No, but it creates a fundamental conflict of interest because their economic incentive is to keep you buying regardless of whether current conditions justify aggressive accumulation, regardless of whether premiums are rational, regardless of whether supply constraints are real or manufactured. They need you clicking, they need you purchasing, they need you convinced that right now, this moment is critical. So what happens to information quality in that environment? It degrades, urgency gets manufactured. Every price dip becomes the last chance. Every supply delay becomes the final warning. Every geopolitical event becomes the trigger that changes everything. And investors get conditioned to operate in a constant state of anxiety, never sure if they're getting legitimate analysis or sophisticated sales pressure. Now, layer on top of that, the dealer incentive structure. Dealers make money on spreads, the difference between what they pay for product and what they sell it for. When premiums are high, their margins are high. When availability is tight, they can justify higher spreads. So what's their incentive when a customer calls asking about market conditions? To downplay supply concerns, to assure them that delays are temporary, to encourage immediate purchase before it gets worse. Again, not inherently dishonest, but the information flow is colored by commercial objectives. Now, the customer isn't getting disinterested analysis. They're getting information filtered through a sales framework. And then you have the YouTube algorithm problem. The platform rewards engagement, views, watch time, clicks. What drives engagement in precious metals content? Controversy, extreme predictions, conspiracy theories, emotional narratives. The more dramatic, the more sensational, the more fear-inducing or greed-triggering, the more the algorithm promotes it. So content creators, even well-intentioned ones, face pressure to escalate rhetoric, to make bolder claims, to promise bigger moves, to warn of more severe consequences, because measured, technical, nuanced analysis doesn't get recommended, doesn't get shared, doesn't build audiences, and the information environment becomes increasingly polluted with noise designed for algorithmic success rather than analytical accuracy. Now add in the classic problem of expertise signaling. In precious metals markets, there's no licensing requirement, no credential verification, no barrier to entry. Anyone can call themselves an analyst. Anyone can start a channel. Anyone can offer market commentary. So how does a retail investor evaluate credibility? They can't check credentials because there aren't any. They can't verify track records because most claims are retrospectively adjusted. They can't assess methodology because most content doesn't explain methodology. They're left evaluating based on production quality, personality, confidence, subscriber counts, none of which correlate with analytical accuracy. This is the environment most investors navigate, flooded with information, starved for reliable intelligence, unable to distinguish between legitimate early warnings and manufactured urgency, unable to separate supply chain analysis from inventory liquidation tactics, unable to identify who's providing strategic intelligence versus who's optimizing for affiliate commissions, and the cost of this information asymmetry is substantial. Investors buy at premiums they shouldn't pay. They panic during corrections they should anticipate. They miss accumulation opportunities because they're waiting for crashes that never come. They overweight positions because someone manufactured urgency. They underweight positions because someone downplayed structural changes. All because they're operating with corrupted information in a market that punishes mistakes slowly, silently, but severely. Now, contrast that environment with what Andy Schectman validated. He didn't praise OG John for having the most subscribers. He didn't acknowledge the most dramatic predictions. He didn't validate the most confident personality. He specifically highlighted early recognition of a technical problem, refinery constraints, before mainstream awareness, before it was safe to discuss, before it became consensus. That's a completely different standard. That's not about entertainment value. That's not about affiliate optimization. That's about analytical accuracy and timing. And here's why that distinction matters strategically. In markets characterized by information asymmetry, where most participants operate with incomplete or corrupted intelligence, the ability to identify credible early warnings becomes the single highest value skill. Not the ability to predict prices, not the ability to time perfect entries, but the ability to recognize structural changes before they cascade into market-wide disruptions, because that's where actual strategic advantage lives, not in reacting faster than others to the same information, but in seeing problems earlier, understanding implications deeper, positioning before consensus. When Schectman publicly acknowledged that OG John identified refinery problems ahead of industry recognition, he wasn't offering polite professional courtesy. He was validating a specific analytical capability, the capability to cut through noise, to focus on mechanical realities rather than price predictions, to analyze supply chain architecture rather than chart patterns, to identify vulnerabilities before they become crises, and in an information environment as polluted as precious metals markets. That validation carries extraordinary weight because it comes from someone who has nothing to gain from public endorsements, someone whose business depends on accurate market intelligence, someone who deals with institutional clients who don't tolerate nonsense, someone who's been in this industry long enough to have seen every manipulation narrative, every conspiracy theory, every hype cycle, every crash prediction, and still chose to publicly separate one analytical voice from the crowd. That's not accident. That's recognition. Recognition that in a sea of noise, systematic analysis still exists, still matters, and still provides the strategic advantage that serious investors need, especially now, especially as supply chain vulnerabilities continue to evolve, especially as the gap between paper-silver liquidity and physical delivery capacity continues to widen. The investors who understand this, who prioritize information quality over information volume, who seek early warnings over consensus confirmation, those are the investors who will navigate what's coming, not with perfect timing, not with guaranteed outcomes, but with better intelligence than most. And in uncertain markets, better intelligence is the only sustainable edge. So we arrive at the question that actually matters. What do you do with this information? Because validation is interesting, early warnings are valuable, but none of it means anything if it doesn't translate into better decisions, better positioning, better outcomes. And this is where most investors fail, not because they lack information, but because they don't know how to convert intelligence into action. Let's establish a foundational principle first. In markets where supply chain integrity cannot be assumed, where refinery capacity is constrained, where delivery timelines are uncertain, where physical availability disconnects from paper price signals, the traditional investment framework breaks down. You cannot treat precious metals like equities. You cannot assume liquidity on demand. You cannot rely on spot price as the primary decision variable, because spot price tells you what paper contracts are trading at. It doesn't tell you whether you can actually get physical metal. It doesn't tell you at what premium. It doesn't tell you how long you'll wait. And it certainly doesn't tell you whether the supply chain will function normally next month. So the first strategic implication is this. Your allocation decisions must incorporate supply chain risk, not as an afterthought, not as a footnote, as a primary variable. If refinery constraints are real, if margin pressures are freezing capacity, if delivery timelines are stretching, then waiting for the perfect price is a fundamentally flawed strategy. Because you're optimizing for price while ignoring availability, you're focused on saving a few percentage points on premium while risking the inability to acquire product at any premium. This is not fear-mongering. This is basic supply chain logic. When bottlenecks tighten, when capacity freezes, when delivery queues extend, the window for rational allocation closes, and it closes faster than most investors expect. By the time mainstream media is discussing supply problems, by the time your local dealer is admitting extended delays, by the time premiums spike to irrational levels, you're not making strategic decisions anymore. You're competing with panic buyers for scraps of available inventory. So, what does proactive positioning look like? It starts with recognizing that dollar cost averaging in a constrained supply environment requires modification. Traditional DCA assumes continuous availability at market-determined prices. But when supply is questionable, you need to weight your accumulation toward periods of confirmed availability, even if premiums are slightly elevated. Because the cost of missing allocation windows exceeds the cost of suboptimal entry prices, think about that carefully. If you wait for premiums to compress, wait for the perfect buying opportunity, and during that waiting period, refinery constraints tighten further. You might save $2 per ounce on premium, but you might wait 6 months for delivery, or you might not get allocation at all. The opportunity cost of that delay, the strategic risk of that unavailability, far exceeds the premium savings you were chasing. This is the difference between retail thinking and institutional thinking. Retail investors optimize for price. Institutional buyers optimize for certainty of delivery. They understand that in constrained markets, availability is more valuable than price, and they're willing to pay for that certainty. Second strategic implication, counterparty selection becomes critical. Not all dealers are equal when supply chains are stressed. Some have direct refinery relationships. Some have allocated capacity. Some have inventory buffers. Others are simply order takers who depend on wholesaler availability. When supply is abundant, this distinction doesn't matter much. But when constraints bite, the dealers with direct relationships and allocated capacity can still deliver. The order takers start experiencing indefinite delays. So your choice of counterparty isn't just about pricing anymore. It's about supply chain position. It's about whether they have actual access to product or just a website and a prayer. How do you evaluate this? Ask specific questions. Do you stock inventory or dropship? What are your current delivery timelines and why? Do you have direct refinery relationships or buy through distributors? What happens to my order if your supplier can't deliver? The dealers who can answer those questions with specificity and confidence, those are the counterparties you want when supply is uncertain. Third implication, physical versus paper exposure requires serious reconsideration. ETFs, mining stocks, futures contracts, they all provide precious metals exposure, but they don't provide physical delivery certainty. And in an environment where refinery capacity is constrained, where the gap between paper price and physical availability is widening, that distinction matters enormously. You can own SLV shares, you can own mining equities, you can hold futures contracts, but if a genuine supply crisis emerges, if physical premiums spike to unprecedented levels, if delivery becomes genuinely difficult, your paper exposure doesn't solve that problem. You still can't get physical metal. This doesn't mean paper exposure is worthless. It means you need to understand what you actually own and what it can and cannot do for you in different scenarios. If your thesis is that precious metals will appreciate in value during monetary instability, then paper exposure might capture that. But if your thesis is that supply chain fragility will create physical scarcity, then paper exposure is strategically insufficient. You need actual metal in your possession or in allocated storage. Fourth implication, information sourcing becomes a strategic priority. Not entertainment, not community, not personality-driven content, strategic intelligence, early warnings, supply chain analysis, the kind of unglamorous technical work that identifies problems before they become consensus. And this is where Andy Schectman's validation provides genuine value. Not because it tells you what to buy, but because it tells you where to find credible early warnings. In a market flooded with noise, with conflicting narratives, with incentivized information. Knowing which sources consistently identify structural problems ahead of mainstream recognition, that's valuable. That's actionable. That's the foundation of better decision-making. So the strategic question becomes, are you listening to voices that help you react faster to consensus information, or voices that help you position before consensus forms? because those are fundamentally different value propositions, and they lead to fundamentally different outcomes. Fifth and final implication. The next early warning matters more than the last one. Refinery constraints were yesterday's early warning. Now it's mainstream knowledge. Now everyone knows. Now it's priced in, discussed, acknowledged. The strategic value has been extracted. What matters now is identifying the next vulnerability, the next supply chain weakness, the next structural problem that hasn't hit mainstream awareness yet, because that's where positioning advantage still exists. And this is the discipline that separates strategic investors from reactive ones. Strategic investors don't celebrate being right about yesterday's call. They're already scanning for tomorrow's problem, already analyzing the next potential bottleneck, already asking what everyone else isn't paying attention to yet. So where should attention focus now? Mint capacity, logistics infrastructure, storage availability, regulatory changes affecting bullion movement. These are the unglamorous technical questions that might contain the next early warning. The next problem that's developing quietly while everyone argues about price predictions, and the investors who identify those problems early, who position before consensus, who secure allocation before constraints tighten, those are the investors who will navigate what's coming, not perfectly, not without volatility, not without uncertainty, but with better intelligence, better positioning, better outcomes than those still operating on outdated assumptions about how these markets function. Andy Schectman's validation of OG John wasn't just acknowledgement of past accuracy, it was implicit recognition of a framework, a discipline, an analytical approach that prioritizes mechanical reality over narrative, supply chain architecture over price prediction, early problem identification over consensus confirmation. And for serious investors, for business decision makers, for anyone allocating capital in precious metals, that framework is the difference between strategic positioning and expensive mistakes. The question is whether you recognize that, and whether you're willing to prioritize information quality over information volume. Because the markets don't care about your opinions. They don't reward confidence. They reward accuracy and timing and the discipline to act on credible intelligence before it becomes obvious to everyone else. That's the lesson. That's the implication. That's what matters going forward.